Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. Well, in recent weeks, investors have feasted on a lot of good news. At the G20 meeting in late June, investors found out on June 30th that trade talks between the U.S. and China would in fact resume. On July 5th, investors were treated to a very strong employment report, 224,000 new jobs in June, showing that the U.S. economy is doing just fine. Also on July 10th, the Federal Reserve, namely Jay Powell, indicated that the Fed would in all likelihood cut rates on July 1st. With so much good news, why should anyone be worried about the market? Well, there's an old Grateful Dead song that says, when life looks like Easy Street, there's danger at your door. All right, back on June 28th, I did a quick video. Will trade talks resume? My conclusion was yes. One of the reasons why I thought the S&P and the Dow were poised to rally to a new all-time high. As the chart shows, since January 2018, the S&P has been forming a megaphone pattern. And this basically is a correction within a bull trend. So as you see off on the left, the green number 3 in parentheses indicates that that was the end of wave 3 from the March of 2009 low, and that this is wave 4. The reason for concern is that this megaphone pattern suggests that after wave D, you see with the question mark, tops out, probably in the next couple weeks or so, wave E would take the S&P all the way down to new lows below the low in December. In the short term, though, I think the market is okay over the next 1 to 2 weeks. A couple reasons why. The New York Stock Exchange advanced decline line continues to make new highs. The percentage of stocks above their 200-day average continues to work its way higher. However, at 63%, that's not an unbelievably good number. In a really strong market, it's typically above 70%. Also notice off to the left on both the advanced decline line and the percent above the 200-day average, you can see last September and October, both the AD line and the percent began to hit lower highs even as the S&P was making new highs. I think something like that could develop in the next few weeks. One of the reasons for concern is optimism. All this good news has turned a lot of people bullish. The call-put ratio is above the red line. And as you can see, going back the last 18 months, whenever the call-put ratio has gotten above the red line, it has indicated that the market was near at least a short-term high and potentially a deeper correction. The Nasdaq advanced decline line paints a completely different picture than the New York Stock Exchange, in large part because it doesn't have a lot of interest-sensitive issues like utilities, muni bond funds, and regular bond funds. We can see that the Nasdaq AD line is way below where it was last fall and even below last April. So although the Nasdaq averages are making new all-time highs, a lot of stocks aren't participating. The table shows how various averages are compared to their prior high, and we can see that numerous averages are well below their prior high. In a car, the pistons, when they all run together, the car rides smoothly. You have car trouble typically when the pistons start to misfire, and what this graphic shows is major averages are not all in sync to the upside. That's another warning sign for the next 1 to 3 months. The Russell 2000 is one of those averages that has really underperformed. This shows the relative strength of the Russell compared to the S&P, and you can see since peaking last fall, it has been declining rather significantly. Lastly, looking at earnings, we can see going up into the fall of last year, the earnings estimates for 2019 and 2020 were on top of each other. But since then, there's been a huge shift. Earnings are expected now to grow about 2% for 2019, but still about 11% in 2020. So this huge gap, I think, is going to get closed, and I think earnings estimates at some point in time are going to be ratcheted down for 2020, and that, I think, is going to be a point of vulnerability for the stock market. So how far could we drop? I think the S&P could drop to 2750 just in a normal correction. If trade tariffs are further enacted because trade negotiations break down, that would probably justify a move back to the lows of December. So the next few weeks and months are going to be quite interesting. Thanks for tuning in. May good things happen for you today.